Hey guys, Jason Sharon here from Homes Inc. talking to you about how to calculate your debt to income ratio. So, a little bit about me. I was in the Navy for 20 years, enlisted for 9, commissioned as an officer for 11. I got my loan officer license in March of 2015. I started my own company in March of 2018. I'm licensed in West Virginia, Virginia, North Carolina, South Carolina, Georgia, Florida, and Alabama. And a little fun fact about me, I'm a certified barbecue judge. Production, 65% loans, VA loans. I'm about 30 units per month, which is significantly above average for the industry. I've written 3 books on mortgages: VA Mortgage Declassified, I Hate Renting, and Mortgages for Realtors. Working on another book right now. I've been interviewed by several national mortgage magazines, including Money.com, National Mortgage Professionals of America, and Housing Wire. What is debt to income ratio? Why does it matter? So there's a couple different debt to income ratios. There's a front end ratio and the back end ratio. Your front end ratio is going to be your new housing payment divided by your gross monthly income. Your back end ratio is going to be the total debt payments, including the new mortgage payment, divided by your gross monthly income. Let's calculate some examples and put this to an application test. So let's say you're making $25 an hour and you average 40 hours a week. Your gross monthly income is going to be 25 hours a week. $25 times 40 times 52 divided by 12 months per year. So you can be about 43.33 per month. Let's calculate a debt example. Let's say your car payment is 450. Your Visa is $25 a month minimum payment. You go off the minimum payment for revolving accounts. You have a MasterCard of $50 per month, an installment loan of $100 per month. And let's say the new mortgage payment is going to be $1,500 per month, including tax and insurance. And it also includes your homeowners association fees as well. So your total debt is $2,125 per month. I want you to notice something. I did not include utilities. I didn't include cell phone, water, electricity, car insurance, that kind of stuff. It's just your debts. So let's say you get a front end calculation: $1,500 a month divided by the 43.33 is $35, 35% DTI calculation. Is this okay? Probably, but it could not be. We'll talk about that in a minute. Back end calculation for this exact scenario: 2125 divided by 4333 is 49.04%. Is this okay? Probably, but maybe not. We'll talk about that. Debt to income ratio limits are very complex. There's no way I could cover them all in a simple video, but we'll have some high level discussion of them. So, on a VA mortgage, there is no debt to income ratio limit. A lender may implement a max DTI limit, but the VA guidelines have no max debt to income ratio limit. VA does have a residual income limit, which I cover in another video in this channel, which is very, very informative on how to understand residual income limits. If you are a manual underwrite, which I discuss how to win a manual underwrite in another video, I routinely see lenders implement a limit of 50% debt to income ratio. I have another video on how to win a manual underwrite as well. Check that out. It's going to be very helpful to you if you are a manual underwrite. So let's talk about conventional mortgages. A little bit more complex than VA. 49.9% is a hard stop for conventional mortgages. No ifs, ands, or buts about it. That limit will be reduced to 43% in the future, probably the near future. I would anticipate here in 2021, possibly in 2022. The automatic underwriting system may set a lower limit based on other risk factors in the loan, such as credit score, credit history, assets, um, down payment, loan to value, that kind of stuff. USDA is the most stringent debt to income ratio limits. They are very tough. On the front end ratio limit of 29%, back end ratio of 41%. There are some exceptions. You can get on a very strong file, you get a 2% limit raise on either the front or the back. I wouldn't count on that though. It's very tough to get. FHA limits are definitely the most complex. There's no front end ratio limit for automatic approval, and the back end automatic approval limit is 56.9%. I've closed loans in the 56% range. If you're a manual underwrite, you're going to have a hard stop at 40% front end and a 50% back end ratio limit. And you're going to need compensating factors for those. So, compensating factors are extra money in the bank as reserves, minimal housing increase from what your rent payment is, very good job stability, low residual income calculation, that type of stuff. If you have no credit score, it's a hard stop: 31% front end ratio, 43% back end ratio. States I'm licensed in: West Virginia, Virginia, North Carolina, South Carolina, Georgia, Florida, Alabama. My contact information here, 843 low rate for my phone number, jason@homeloansinc.com. And if you would, please like and subscribe. It helps a lot. You like this and subscribe, it's going to show it to more people, which is going to help more people understand debt and income ratio limits. Appreciate y'all. Have a great day. Bye.